Kimberly-Clark is a powerhouse when it comes to the tissue and toilet paper market. So in this video we're going to be analysing the company, seeing if it's worth being in your portfolio.
I fight to live, I fight to strive. One day I'll have what I want in life.
How's it going? Welcome back to another video. This is on Kimberly-Clark. My name is Zexo and I hope you enjoy the video. Kimberly-Clark Corporation manufactures and markets personal care and consumer tissue products worldwide. It operates through three segments: personal care, consumer tissue and KC professionals. The professional care segment offers disposable diapers, baby wipes, feminine care products and other related products under the brands Huggies, Pull-Ups, Little Swimmers, Good Nights and other brand names. The consumer tissue segment provides facial and bathroom tissues, paper towels, napkins and related products under the Kleenex, Scott, Viva, Andrex, Scottex, Neve and other brands. The KC professional segment offers wipes, tissues, towels, apparel, soaps and sanitizers under the Kleenex, Scott, KleanGuard and other brands. When you look at the data, in the USA, Scott equals 61.53 million users and is ranked number 3 in USA. When it comes to the UK, Andrex equals 10.8 million and is ranked number 2. When you look at diapers on Amazon, Huggies are number 3, Goodnight is number 13 and Huggies is ranked number 3 in the UK. If you look for tissues on Amazon, you'll find everything being Kleenex, bar the first one being an Amazon brand, as they are trying to push that. And if you Google the best tissues, Kleenex is ranked second, with Puffs being considered better, and that is Procter & Gamble. They own Puffs. It has a decent dividend yield of 3.35%, paying a dividend of £4 or €4.28 per share, with a cash flow per share of 8.62 and a free cash flow per share of 2.14. The current share price as of the 17th of May is 135.79. Okay, so now we've looked at the background of KMB and what they do. We'll take a look at some of the fundamentals of the company, the analytics, look at the income statement, stuff like that, and then we'll make a conclusion on the company. So look at evaluation. You always need to buy a company undervalued, basically, unless you're trying to increase your position in it, but there is a way to do that. So if we look at KMB, using a two-step discounted cash flow, we can see that KMB is trading below its fair value. It's currently trading at 134.18 and its estimate fair value is 194.51. So very nicely undervalued there, if you can get into that. The PE ratio is in line with the market and a little better than the industry, not by much though, but still something. Now, future growth of the company, the annual earnings growth is expected to be 4.8%, only slightly better than the industry at 4.1%. And the annual revenue growth is predicted to be 2.6% versus the industry of 3.5%. Past growth over the 5 years has been 5.1% compared to industry of 12.1%. And last year's earnings are very bad, leading to a minus 3.7% earnings growth. If we have a look at debt, we can see that the debt level of KMB seems to be quite high. It says debt to equity ratio of 1,111.8%. Yeah, considered high, it says. Yeah, I would say so. However, it has been reducing its debt to equity ratio, has reduced from 2,413.2% to 1,111.8% over the past 5 years. The debt coverage of KMB is well covered by its operating cash flow of 40.3%, and the interest coverage, the interest payments on its debt are well covered by its EBIT of 13.8x coverage. Okay, just a little side topic to do with its dividend. If you buy within the next 16 days, you will receive the next upcoming dividend. The ex-dividend date is June the 3rd. Okay. A bit more on the dividend side of things. I'll show you on screen now the dividend growth. So KMB's dividend per share have been stable in the past 10 years and they have been growing in the past 10 years. I can show you this on another graph as well. The current payout to shareholders is 65%, and this is well covered by its earnings, and the future payout to shareholders is 59%, and again that'll be well covered by its earnings. So when we look at the ownership of this company, we can see the general public, that would just be like me or you. We as investors hold 23.7% of the company, and as shareholders we have not been meaningfully diluted in the past year, which is a good sign, and the dividends have been paid and grown for the past 48 years. Okay, so now we'll take a look at the income statement, balance sheet, cash flow, and get a conclusion on the company. Okay, so now we're on the income statement of Kimberly-Clark. We're in the annual view. Everything is in millions of USD except per share items, important to note that. And we can see all the way back to 2016. If you pay for it you can get further back, but this should be alright for what we need. So we'll take a look at the revenues first. You can see here it has no other revenues, so the total revenues will just be the same as this. So we can see that from 2016 2017 there's an increase, 2018 another increase, and then 2019 there's a little decrease, with a 2020 having an increase, and then trailing 12 months dropped a little bit there. So it seems to fluctuate around that 18,000 range. Ideally you want to see this growing a bit more. Let's go back there. There you go. Yeah, ideally you want to see this growing a bit more. If we then take a look at gross profit, we can see that there was a decrease, another decrease, and a little increase there, an increase, and then a decrease there. So gross profit you can see is a lot less stable than the revenue is. In 2018 the payout ratio, you'll see later, did have a big spike, and that threw off quite a lot of these numbers, so we'll take a look at that. The operating income, we can see we've had a decrease there, a little increase there, an increase, and then a decrease again. So again, operating income has not been that steady either, which is strange considering the type of company Kimberly-Clark is. So the type of company Kimberly-Clark is human need to have their products, so it's strange to see all these fluctuations. If we look at net income, we can now see we've had an increase there. That's the big decrease there. That's because of the payout ratio. I'll show you that. And then it recovered, and then increase and increased. No, it decreased there a little bit. So it was nice that it recovered from that. But again, the growth is just seems to not be there in terms of their money. So that's one bad thing. It's just a bit stagnant. It's expected to be that for an established company like Kimberly-Clark, but still having like no growth like this is not ideal. One good thing is the revenue per share. We can see it's increasing year over year, and it's continued to do that. And then trailing 12 months had a bit of a decrease, but other than that, year over year the revenue per share was increasing, so that's good to know. Earnings per share increase there, had a big dip because of the power ratio, and then managed to recover, and then increase, then a little drop trailing 12 months. The trailing 12 months for this company don't seem to be the best. If you look at normalized basic EPS, you can see increase, and then it's not as bad there with a decrease, but it's still a little bit, and then increase, and then decrease again. So same picture. Dividend per share, again, increase there, increase. So it's good to see they're able to keep doing that. If you look at the power ratio and their cash flow, it seems to be able they can sustain this with a 60% payout ratio, then 59. This was that big 98 that threw off a lot of the metrics, and then they dropped it back down to 65, 61, 63. So they hover around that range quite nicely. Okay, so now we'll take a look at the balance sheet and the cash flow statements, and then we'll wrap up there. Heading over to the balance sheet of Kimberly-Clark, we'll start by analysing the current assets. So from the current assets you can see that it's increasing there, but then decreased. It's just not really increasing that much. However, if you do look at the total assets, which are down here, it paints a bit of a better picture. So you have a nice increase there, and then we had decrease there in 2018 when they had that massive payout ratio also. And then in December 2019 increased beyond that, and then another increase there, and then so in these 2 years they got more assets than these ones by quite a substantial amount. You can see here as long-term investments have been increasing as well. So we need to look at that in relation to their liabilities. So we can see the current liabilities are down here. So if we look at the total current liabilities, if we scroll down a bit further actually, we can look at these as well. So we can see increase there, increase of liabilities again, increase of liabilities again, and then they've decreased it there with an increase again. So they seem to be increasing liabilities. What's the total? Can I zoom out a bit more? There we go. So we can see total current assets. The total current liabilities are bigger than the total assets there. What about for, yeah. Okay, so that's not a good sign. The total current assets at the minute do not outweigh the total current liabilities. Do the total assets outweigh the total liabilities though? Okay, so the total assets do outweigh the total liabilities. So that's one good thing. It would be ideal for the total current assets to outweigh the total liabilities. That would give a bit more financial stability for the company, a bit more financial health, but it's not too worrying. With the amount of cash they'll have in their operating cash flow, I think they'll be alright. We can see from here total debt and net debt that everything here has been increasing. Debt's not necessarily a bad thing, you just need to know how to manage it. So with their operating cash flow they seem to be able to manage it, and it's all well covered by its earnings and whatnot, so I'm not too worried about that. So now we'll take a look at the cash flow statement and then we'll be done and wrap it up. Okay, so looking at the cash flow of Kimberly-Clark, again annual and in millions per share. We've already looked at net income, so we don't have to look at that. There's not too much to look at on this page as we've covered the main point of cash flow and free cash flow. So it seems that this company, if you look at the cash from operations, you can see it's not really been doing too much, which is weird considering the type of company. I think I've said this already, but being a company that sells consumer goods and the type of consumer goods they are, they're a necessity for people to use every day. So it's strange to see how this is not more stable. You can see it's just like up, down, up, down, up, down. It's just weird. Cash from investing, they seem to be investing a lot recently. And it's also just been ramping this up through the years. So I guess they're trying to store some of that capital they have. We've already covered the debt to equity and all that, and we know that's paying back its debt alright. It's managing that with its free cash flow and operational cash flow, so it's all good on that. And you can see debt repaid here. So net change in cash is an interesting one to look at. They seem to be holding a lot more in cash the last 12 months. They had decent cash in 2016, 2017, then 18, 19 and 20 they had low cash, but trailing 12 months they seem to have a lot of cash. Strange. You can look at free cash flow as well, and you can see it going up, well, just hovering around that £6 mark. Had a high in 2020 and then back down a little bit there. That's where we're sitting at currently, so you can see at least it holds that relatively well. See, this is when you don't want it to change too well, much really. You always want free cash, so they seem to be doing that. They can up this number if they want. I would be happy about that, but seems to be a very stagnant company. Anyway, we'll get into the conclusion, wrap it up, and I'll give you my opinions on the company. So my thoughts on Kimberly-Clark as a company, it's very strange. I think it's just due to how old the company is now and the type of product they sell. You can't really innovate it anymore. It is what it is. so there's not really much room for growth anymore. That's why the growth is so slow. The dividend is okay for most people. Me personally, I'm trying to get my portfolio up a bit, so I don't typically look at these 3% dividend companies too much at the minute. I'm trying to look for more in the 5% range or 4% range, something like that. So this is close to it, and the valuation is good. There's another thing going for it, so that's the reason I am in this company a little bit, due to the valuation. I wanted to get in on discount, and the stability of this company is really nice to have. It doesn't fluctuate too much at all, as you've seen. The price doesn't fluctuate too much either. You can always find a good discounted point you can get it at. It's just not an exciting company really that people look at, it seems. So you'll have to make your opinion on whether this company will fit in your portfolio. Again, none of this is financial advice. I'm not a financial advisor. I do this for my own benefit and just to share some information about companies and hopefully grow this channel and get to know some people. Alright, so I hope you enjoyed anyway. If you did, like, comment, subscribe, all that good shit. Check out my other channels. My EXO is the one you're on, EXO Gaming, that's another one, it's just more chill over there. And then EXO Diving is more extreme sports. All the links in the description for Trading 212. You can get a free share using my link. Cryptocurrencies, you can use my BlockFi account and my Gemini account links, and you can get some free crypto doing that. Alright, in a bit. Peace.
Tell me pretty lies, look me in the face. Tell me that you love me, even if it's fake.